Okay, I think we can start. There's some issue with my video, so please bear with me. But okay, I think one of the most frequent questions that we keep getting asked is, do I invest in a passive fund like an index or an ETF, or do I really look at active funds? And this is a question that I keep getting on all webinars that we do. Even on the last webinar that I had done for large caps and the opportunity that's there in large cap funds. I got this question that, okay, you're telling me that yes, large caps are a great option, but do we look at uh, passive large cap index funds, or do we look at ETFs? And I thought that this is a good opportunity to really talk about how we are looking at ETFs and how we should be looking at index funds, ETFs versus that of active funds, right? So let's look at why passive. See, most people look at passive as a low cost product. It's giving you the same diversification. It allows you to customize whatever index that you have as per your own. That is the manufacturer will do that. The AMC will take up whatever index that's there and try to uh, fit it within their own product management philosophy to give us a unique product that investors can use to invest in, right? That is what we do as individual investors. Second, for corporates, that is for institutions, it's giving them really easy access to broad segments of the market, right? It's coming for them at a very low cost, right? They don't really have to think of what the fund manager is doing, nothing of that sort. For them, it's nothing but, yes, this is a savings vehicle. I will use this as an extremely liquid product. It is easily accessible to me on the exchange. So yes, it is some sort of a cash equivalent for them, which is coming to them at a very low cost, right? And then there are all sorts of other uses for passive funds. You see, they use it for hedging, and that's usually not the use case for most of the market. But yes, there's definitely a use case. So basically, anybody who has uh, it's really good for institutions and corporates because they are getting easy access to the market at a very low cost, right? But is it really good for individual investors? Let's really check that out. Now, let's run a poll. How much are passive funds or ETFs as a percentage of your portfolio? Right? Is it less than 10%? It is somewhere around 10% to 25. Is it 25 to 50, or is it really more than 50%? So put in your answers in the chat box. Uh, okay, we have a. So put in all your answers in the chat box. I'll just give a minute or so we can take stock, and then I'll move on. A. Okay, there's one more A, so it's less than 10%. Okay, 10 to 25. Good answers coming in. Okay, great. I think we're getting a mix of A's and B's, which means that all of you here, most of your portfolio is somewhere having at least maximum of 25% that's coming in passive funds or ETFs. Now let's look at the ETF market really, right? So ETFs have grown tremendously in the last 3 years, right? So we always have this ideology that we need to look at developed markets, and developed markets, the ETFs that are there are really good. But one thing we're forgetting is there are a lot of innovations that have taken place in terms of financial products in the US. Right, in all developed markets, that's what has happened. Right, there are specific passive fund houses that only do ETFs or only do index funds. They're only giving you innovative products. They're only giving you somewhat complex products as well. Right, and that market is really big. Right, but we are just starting off on our ETF journey. So all data that I have taken, they are all public data. They are all available on product presentations, product notes. So I've taken everything from there. Right? So it's nothing that new that I'm telling you. It's just I'm making you all aware of something that is already out there. Right. So The number of ETFs also has gone up. The schemes, they were nothing. They were probably about 50 or something about 5 years back, and now it's three times that. It's more than three times that. It's about 175 schemes. Right? Uh, and it's an exponential jump in terms of AUM in the last 3 years, because we've all become aware that yes, passive is an option for us to do. But are retail investors really taking advantage of passive funds? What's really happening on that space? Right? That's the question that we should be asking, right? We can't look at developed markets and say, yes, that's the same template that we're going to use here in India. That's not really how it works. The way we operate as a country, the way we are as investors in India, they're completely different from that are there in developed markets. Though we can look at trends, we can look at what's happening, we can see what suits us. But the real question that we should be asking is that exponential jump that has been coming in, where is it really coming from? Right. So if you look here, uh, this is slightly dated a couple of months back, but it's very relevant data. Most of the ETF market growth has come from government ETFs. Right, they're a mix of debt and equity. Right, index funds happen to be a good chunk, but majority is coming in from government ETFs. Uh, and ex-government ETFs are very low, right? Though the number of ETFs that are there on the ex-government sides, they are really high, but the AUM that's there in those schemes, they have been very low, right? Which means that the participation that has been coming has been extremely low on that side, right? It's majorly government ETF driven, which means that they are all your CPS ETFs, your Bharat 22 ETFs, your Bharat bond ETFs. All the money is really in there, right? Where your passive and your ETF and index funds really get their money from. This is where people are really going, right? It's all government opportunities that investors are really looking to invest in. If you see the growth, also growth has been going up significantly. Even now, it's about 5,80,000 crores. That's what we saw on the last slide. But passive is growing, right? It's still a small chunk of our 46, 47 lakh crore, but it's still growing. Right? Now let's look at where the money is really coming from, right? So if you look at the ETF folios that are coming, this is public data. 98% of all ETF folios, they are retail, right? They are all retail investors, but the contribution that is coming in terms of AUM for these ETFs, they are just about 2%, right? That's a very, very small number. That's a very, very small number, which means that people are who are investing in the passive funds, right? Their ticket size are really small, and it's majorly driven by corporates. So if you look at corporates, 90% of the ETF AUM that's there, they are contributed by the corporates. And if you look at their folios, they're very low. Yeah, corporates are really big, right? So their folio contribution would definitely be low. But about 98% is coming in from the retail side, and they're not really contributing anything in terms of the big chunk of AUM that's there. Right? So retail participation, just in terms of volume, is very high, right? But in terms of value, it's really low. Right. Now, why is that low? What is really happening to that space? Right. Next. So where do passive investors really invest their money? Let's talk about, so, that 10-25% of whatever is there. Right. Where are you really going and investing it? Is it going into small cap ETFs or index funds, mid cap ETFs or index funds, sectoral or thematic for that matter, ETFs or index fund, or is it going to large caps in ETFs or index funds? Right. So put in your answers in the chat box. Okay, we're getting a mix of C's and D's. I'll wait for a couple of more seconds so that we get more responses. Okay, D. I'm quite shocked. A lot of investors are really looking at large cap ETFs and index fund, where there are so many active funds on the large cap side. But anyways, it's a good mix of C and D, but majorities have been D, right? For the number of options that we have been presented with on C's and B's, majorly on C's, sectoral thematic. Uh, Yet investors are really going towards only D, that is more large cap oriented. There are plenty of options on the active side. So are we really taking advantage of small cap? Are we really taking advantage of the small cap and mid cap ETFs or sectoral ETFs? Are we really taking advantage of passive? Right. That's number one. And that's one question. And second question is, okay, why is it that investors have shifted from active to indexes or passive? And is it really a good option? Why is it that active has really missed out? Right. Let's sort of address that. Now, are ETFs really liquid? Let's look at the trading volume of ETFs. Right. In this year, we've had 72,000, 80,000 odd crores of trading volume. Right. Since 16, it has been going up, and likewise, this year also it is going to go up. So trading volumes have been slowly going up, right? Though in terms of the total AUM that's there, it's about 20% that gets traded, and everything else is not traded. Everything else is sort of a hold, sort of a strategy. So basically, there's just a segment of passives that are really liquid, right? Though the AMC does take in charge and creates you that unit, it really behaves like a small cap, right? There is an impact cost that you're taking because of low liquidity, right? Not all ETFs are liquid, right? And if it's an ETF, there's no trading that happened. It's more or less it's all taken up, which means it's all buy and hold. There's nothing that gets traded on a daily basis, right? It's all taken for delivery. Right? So there's only a small segment of the ETFs that are really liquid for retail investors to really take advantage of. And there's a lot of expertise that is required for any investor looking to do passive that is beyond that subset. Now, what is that subset? Yeah. Now, where's the money going? Now, uh, this is as of October 23. That is last month. This month's data is yet to come out. That is November month's data is yet to come out. But you look at this. Right, we've had a lot of money in this year. This is from Jan 23 all the way up until October 23. A lot of money going in into large cap. Like you said, like a lot of investors are really taking use of only large caps as ETFs and index funds. And you look at the total AUM also, the total AUM is also pretty high when it comes to large caps and debt, right? And equity, where's the equity money really going? Right, it's all government. Right, if you look at these are all your government ETFs, these are all your government debt funds, these are all your government index funds, right? Basically your G-Secs or SDLs, they are all that. So a majority of AUM that has been coming, it's only towards your gold, silver, banks as a sectoral. Within equity, we have government equity, and within equity again we have large caps. There's the amount that uh, is there as AUM itself in all the other themes, right? You have so many other themes. You have mid cap, you have healthcare, then you have global, that is China. You have, something value as a strategy. You have consumption as a theme. You have ESG. You have quality. You have alpha, auto, manufacturing. You have so many ETFs. You have so many thematic ETFs and sectoral ETFs which are not really being taken advantage of. Why? You said it yourself, right? Most of you are just trying to cut your costs. You're not really like trying to go out and really take advantage of all these things. And in all fairness, they do require some bit of expertise. So it does require you to actively manage that passive for it to work for you, which means that it's not only uh, buy and hold. There is a good amount of tracking that goes into it. There's a good amount of research that goes into the other segment of the entire market for passive funds, where there has to go a good amount of effort, which clearly from the transaction that has been going in this entire year and the total AUM that's there, investors are not really trying to look at this entire segment at all as an opportunity to invest in. Right now, you look at index funds also, right? Again, on pure index funds, right? It's majorly your debt funds, your large cap funds, and you're having a good amount of mid cap, and you're having a good amount of global. Right. So nothing has really changed from that matter. So if you look at both your ETF and your indexes, it's all debt, it's all large cap, it's all broad based, nothing specific. And investors are not really in that position to take advantage of specific, though there is an option for investors to take advantage of the other segment of the entire market, with a lot of help that comes in from your advisor, or with a lot of help that comes in uh, from other fund managers as well. Okay. Now, what do investors really make when you're looking at passive? Now, this is a good chart that we do on a monthly basis. And if you look at just in Nifty, right, because most of you are large cap ETF or index funds on the passive side. If you look at the first 3 years, it's extremely volatile. And then if you look at the next 6 years, again, there is a good amount of volatility, but it's stabilizing. And from year 5 or year 6 onwards, after that, it is stabilizing well, right? So what do investors really make of when it comes to passive investment? It is around 9 to 12%. Right. Your base assumption is that yes, indexes over the last 30 years, right? If I held something since for 30 years, I still make somewhere around 10 or 10.5%. Right. It is within that band of 9 to 12%. However, on index funds or passive funds, if you do start at a good time, you do tend to make just 1 or 2% extra, depending on what the market condition is at that point of time, and what investors really what is the economic condition at that point of time, and how long do investors need to wait, right? But if you look at this chart clearly, it says that passive investments, the expectations that passive investments have, and what investors have gone out to make on active passive funds compared to active fund, is somewhere around 9 to 12%, right? There's nothing that passive funds really have to do. It's all on the investor. The investor is the one that has to put in that effort to research in, and and to time that sort of entry and exit, right? This is where your entry and exit does come into picture, and 9 to 12% is a good assumption. There have been good years where we've had somewhere around 13 or 16%. Those are very good years, right? That is where your holding period has to be more than 15 years or so, right? That's where your really picture really comes in. When you're looking at 15 years, it's all on the higher side. That's why you compound at a higher side, right? But for the first 6 or 7 years on passive, you are going through a bit of trouble, right? Nifty does go through a bit of trouble, and you are also going to go through a bit of trouble because you are going to be on that side. Now, have passive funds outperformed active funds? Now, you've seen everything. You've seen where the money is really going. You've seen what that money has sort of generated. Have passive funds outperformed active funds, or rather, have active funds outperformed passive funds? Put in your answers in the chat box. Okay, I've gotten 3 A's. There's one no, 4 A's. That is 4 yeses. I think we are going neck to neck. It's somewhere around 4 to 3. That is 4 for passive funds, yes. Okay, 5 for active funds, yes, and 3 for passive funds have not outperformed. Anybody else wants to get that number to 5 so that we can have 1% to break the tie? Okay, I think everybody is sort of heading towards yes, and that your answer is that have passive funds outperform active funds. You guys say that it is yes. So let's look at some data, right? Let's look at some active funds. Now, this is the past, right? Alpha of active funds have really shrunk in the last decade, right? This is all public data. Uh, if you see from 2000 to 2009, there have been good outperformance, but 2010 to 2021, there's been a visible reduction in outperformance, right? This is what this is what you keep hearing, this is what you keep seeing when people talk about, no, I think passives are the future. Active funds are not really generating any money, and we shouldn't be looking here. Why do you want to pay expense ratio? Why do you want to do all of this? But I have more data that is coming in on, other slides. But this is what has happened. We are just taking stock of what has happened from in different phases between 2000, 2009, 2010 to 2021, right? We've seen that the capability that active funds have of generating alpha has been reducing in the last decade. And why is it that they've been reducing? You're seeing that, there has been a lot of regulatory change that is coming in, right? In terms of expense ratio, in terms of benchmarking performance. And then there was SEBI's recategorization of based on market cap, right, which made the entire universe very confined for active large cap managers. This is what I did in the last webinar also, where I showed a good pyramid of what is being considered as a large cap, what is being considered as a mid cap, what is being considered as a small cap. 1 to 100 is large cap, and 100 to 250 is mid cap, and after 250 is sort of small cap till 500, right? So wherever the money is going, fund managers only have to do, it's not only fund managers, it's even the index. The index is constructed that way, right? The active management only comes from within that, right? So money that has been going into these sectors, let's say if money has been going into small cap, which it has been, it has to go only between that 250 to 500, right? Which means it's all getting polarized. It's all being you're just chasing return, right? Because this categorization has made it really difficult for investors and for fund managers to really have alpha over benchmarks, right? And that came in 1819. So there's a good struggle that really took place uh, since that categorization, since a lot of regulatory changes coming in, right? So if you look at the performance of active large cap funds outperforming Nifty 50 over a 3-year basis, that number was quite high. If you look at the number, it was almost 95% before 2017, before this entire regulatory changes started to come in. And after that, you're seeing a drastic fall. This is where your ETF AUM really went up, right? When you saw the first chart that I had shown you, this is where your ETFs had started to go up, right? There's been a lot of churn that has been coming in into the industry. And right now it is settled, right? Right now it has settled very well. Your fund managers have adhere to whatever categorization, whatever rules that have been coming by SEBI, where in this sort of an economic environment where you're operating, even on a regulated environment, you're operating at very high levels, right? Uh, they have done significantly well. Now, let's look at the share of AUM that is outperforming your benchmarks. Now, if you look at 10-year, right, your 10-year large caps have been extremely stable. Where your volatility comes in, and this is where we talk about how, when you look at riskier assets, you do take that risk of massive underperformance on the long term if you don't make the right choice. And going by data that I have seen, even on even in the last presentation that I had done, that investors are really going gung-ho over mids and smalls, right? And here you have where your active share, that means your active outperformance that has been coming, it has been drastically reducing on mid caps, right? Over the last 10 years, yes, your small caps have done well, but it has been coming off that peak, right? That peak it has been met. It's just been coming off, which means your active is not really doing well in specific parts of the market where the money is continuously flowing, right? If you see your mids and smalls, money has just been going there, and your active performance has been coming down. This is not only that, this even so, if you look at 5 years, right, on mid caps, it has been very low, right? It has been extremely volatile and has been extremely low, right? Fund managers are struggling, right? Last 5 years, that's when the rule came in. A lot of fund managers have been struggling, right? But if you look at 1 year and 3 years, that's where you see the magic happen. That's where you see that yes, uh, they have done a good job. Whatever impact had to come in, it has all been come in. And right now they've been coming at a point where it's not working against them, it's working for them now. So if you look at 3-year large caps, the share of AUM that has been outperforming has been going up. If you see On the mid caps, it has been extremely stable. It's not really going up, whereas more money has been going here, which means that it's just being chasing on past returns. It's not really going on in terms of fundamentals or valuation, right? Then again, if you look at focused, which is more concise, more concentrated, that number has been going up. Small cap has been coming down. Value has been going up. Again, if you see on 1 year, right? If you just look at 1 year, they've caught up really well. Right, large caps have caught up really well, and they have been catching up in the last 3 years, right? Whereas your smalls, mids, and other parts of the market, they've been extremely volatile, right? Whereas more money is going here, so you are getting opportunities in parts of the market within the active universe, which is the majority of the entire mutual fund space, where we had significant underperformance during one particular phase. That doesn't mean that they would underperform throughout. That entire phase was just for regulatory reasons. It had nothing to do with the skills of the fund manager. It had nothing to do with valuation. It just had to do with some regulatory change, which the entire industry had to sort of get over, right? And now that point has come where everybody is sort of getting over that. So if you look at uh, uh, just as a category, from a category perspective, if you look at 5 years, everybody has done poorly. Yes, all the regulatory changes did come in, but if you look at 10 years, 10 years, there has been a large chunk of assets under management that has been beating benchmark. Right. So you already have, where all of you have told me that yes, passive is outperforming active. Where is it active? Where is it really outperforming active over the long term, which most investors need to hold for you to make that 12% sort of return, right? That is 10 years plus. Where is it sort of uh, underperforming active, right? You're seeing a majority of assets under management really outperforming their respective benchmarks, right? These are very high numbers when it comes to active performance, right? Now, how much are they really uh, beating those benchmarks, right? That's the price that is coming out from active funds. Now, if you look at the breakdown of our equity AUM, right? Just pure equity, right? This is about 20 lakh crore, 26 lakh crore, right? If you look at active share, which means that 29% of our AUM is low active, which means there is some activity but not as high. And where you see high churn, right? No, though there is a good mix of Q3 and Q4 where uh, in that quartile you are having 50 odd percent that is having a good mix of high and low, which means these are really your less risky but high return generating products, where this is where the real skill of the fund managers do come in. And if you see, it has been stable. It has been stable at 30 35 odd. That number keeps changing based because some go to Q1, they just keep going down. It's not that they've become bad or they're losing share, but that is just in terms of the activity that has been coming in, right? But if you look at this, there is a good amount of AUM that is highly active, and there is a good amount of AUM that has been uh, not very, very active, though activity is there, but not very active, right? And you also have a good balanced approach where 50% of that AUM is sort of balanced, right? Now, this is where our active managing really comes in. So if this is just our Nifty, and if you look at banks, the sector that's there within MFs, this is where our active management does come in, where the fund can go underweight or overweight. So if you look at various sectors, there is active management that has been going on within this entire space, right? Within the entire index itself, you're seeing fund managers do take an active role in going overweight and underweight specific sectors, right? This is all public data. So how have they done? Does active really give you uh, good returns or no? So if you look at one bit where there is extremely low active, it's a stable uh, growth, right? It's not anything to do with volatility, whereas your high active is extremely volatile, right? There are bouts of bad periods, there are bouts of really good periods, right? But on the low, you are stably making that return. And this is what investors are really looking for, right? They want to grow stably, but they want to grow at really, really high rates, right? So active does work. It's not that it's not working, and active has really gone out and outperformed. It's just that there was a period of time where they were struggling, and that period they have gotten over it very well. Right now, you are seeing in the last 1 year, 1.5 years, that yes, there is a good jump in terms of assets under management that has been outperforming their benchmarks. Right now, the benefits of active investing. This is just a fund that's there. They had really good data. So if you look at your indexes, they go through really tough times when a bad time comes because there is no active management that goes in. It's just an index that has a value, and that when we are sort of looking at investing in these indexes, investing in these passive funds, we do take the fall that comes along with it, but the rise that comes along with also is quite low, right? It's just an index that's being tracked, right? But your active management does get to go overweight and underweight specific parts of the market that really work for fund managers, right? And is working for a large fund, that a large chunk of these fund managers. It's not very low, it's quite high. And only in parts of the market it's been working against them, right? And you already saw which parts it's really working against, right? But again, if you see during COVID, uh, we did have a fall on all active, passive also. And the fall in actives have been really low, but the recovery also has been quite uh, stable, right? So if you look at uh, your European crisis, we didn't fall much, but we recovered a lot. If you look at China slowdown, if you look at China slowdown, we didn't fall much, but when it came to 16, 17, where money really got pumped in, uh, they did really well. So active does really well in a good time and protects you really well in a bad time. Right? That's the benefits of uh, active investing, right? Nothing against passive. It's just that you need to know when to do passive and when to do active, right? Active can work for you all the time, but there's no point of you doing passive in a segment that active is doing really well in, and it just has to be a complement to your active. Your passives need to be a complement to your active, right? So whose side are you really on? I'll open the floor for Q&A and then we can have a good dialogue. I do want to know your thoughts. Most of your suggestions were that I do something like this where I show you data on passives and actives and what's really happening in that entire space. So I'm really looking forward to have a good dialogue with all of you. Do put in your questions in the chat box. Sorry, I think there's a comment on very low volume. I don't know where uh, I lost you on. So if you can just tell me where I lost you on, it'll be helpful, and maybe I can do that one particular slide and just share my thoughts on that also. Okay, so there is a comment saying I'm currently investing 50-50 in active and passive within my equity allocation. We do both passive and active. So yes, everybody does a good amount of passives and actives. But my whole point is that uh, if your passive is just doing the same job as your active, then it doesn't make sense. See, a majority of AUM that's there also on passives is majorly on the large cap side. On the within equity also, it's more large cap oriented. At the same time, there are good options for investing in government companies. There's a good option for debt also on that entire side, right? So it's skewed. It's very skewed to just one segment of the market, and there are other segments of the market that investors don't have the current education to really go out and take advantage of. So to take advantage of passive, we have a product within our ecosystem that we are doing. It's Sphere, that's our PMS, where we take advantage of these ETFs that do come in because uh, we should not miss this out. This is a growing space. but doing something, if you're already investing within, Nifty 200, then there's no point of you doing, passives within that entire space. It has to be a complement to your active. And if not that, then you should just stick to active. There's no point of you doing passive unless and until it complements your active. And within active also, there are good segments that are outperforming, right? And for us, uh, we do have, uh, uh, you know, calls that we keep giving, saying where is it that you should be taking advantage of active funds, which segment of the market you need to be in. And uh, uh, so do get on to that particular program. This is the number. So we do this where we are having, high active outperformance. In terms of expense ratio, see, I think when you're looking at active funds, there has been a good change that has been coming in from SEBI saying, uh, there are changes that can come on expense ratio. It might get split up into, costs that are for high performing funds, costs that are for low performing funds. We don't know what's going to happen. But for anybody looking to save money in India, expense ratio does not matter. Whether it is a direct or regular, the difference does not matter, because over a period of time, the only difference that you're going to have in a long term, it's just about 0.5 or 0.7%. There's nothing that you're going to, yeah. And I think the calculation also, according to you, in your head should not be, okay, I made 15, but the expense ratio is 2, so I cut out 2. That's not how you calculate expense ratio, right? Expense ratio is already calculated in the NAV that you're getting. So it's not something that you have to take out after. Right? The calculation that you're really doing is wrong. So there has been a lot of misguidance when it comes to how you need to look at expense ratio. And we have done good content on YouTube uh, regarding direct versus regular, regarding expense ratios. But the whole point is that your long term is not really going to impact you. It's just the impact is just going to be somewhere around 0.5, 0.75, somewhere in that. It will be zero point 0.5 to point to 1. That's the only difference that you're going to do over an extremely long period of time. So it doesn't really matter. However, what really matters is that when you're doing it by yourself on platforms, you are paying platform charges also. You're paying account charges. At the same time, on a yearly basis, you are paying demat account charges also. It's all going through the demat, so you have to pay those charges, right? And unless you have a extremely high ticket, those charges for you are going to look very big, right, over a long period of time. Right? That's what you are really doing, right? For regular, it's more like you are paying for advice and you're paying a very low fee for that advice that is not really coming out of your pocket also. It is just going into the NAV. And it's a highly regulated segment, right? So SEBI is closely watching it. That's why you're having all these changes that has been coming in. So they are working for the retail investor. They're not working against the retail investor. And we don't know how direct is really being marketed for, whether it is for investors or against investors, right? But you do have highly, I mean, regular is highly regulated. So I think in terms of regulation, you need to go where you're safe, and that's quite safe. So mutual fund entirely is highly regulated. So you should go towards that, right? Active. Uh, there is one on active funds also in the long term give the same output. No, it doesn't. I just showed you so much data on how it doesn't, right? There is a good amount of outperformance that is coming in on active funds when you're doing it for an extremely long period of time. See, now that we are growing, money that is coming in into the entire system also is quite high. We are Our SIP numbers are at all-time high. Money is coming in, so high active share within managing a fund is going to be high. It's not that fund managers are not seeing this data that's coming into them. They are the ones who are doing this data, so definitely they know. And the thought that goes on to that also, there are a lot of heads that go into this. So it's not that uh, they are willing to underperform, right? But over a long period of time, definitely there is outperformance. So it's not the same output. I invest in Nifty 50, Nasdaq 100 and bonds only, all SIP. Okay, that's great. You should do SIP. SIP is the best way for you to take advantage of active funds. Uh, Anybody looking, for a good experience in investing without any experience, definitely you can take advantage of passive. But if you're serious investors looking for uh, uh, anywhere between uh, uh, more than 12%, where you're having that sort of where you can take that ability for risk, then you should definitely look at active. Right. Passive invest instead of Nifty, I invest in momentum 50 and low volatile 30. Well, I already showed you the data of how much is momentum and value and volatility as a strategy. It's very, very low. Though there are many indexes that are there, benchmarks that are there, there are very less products, and uh, what really gets traded in and traded also is quite low. So let me just go back to that. That's one of my favorite slides here. Yeah. If you see here, volatilities are about the entire AUM is about 2,600 crores, and when it comes to your momentum, momentum is nothing. It's a very small sum. So you are taking impact cost. You are taking a lot of costs that are coming in when you are doing uh, this sort of activity, because the AUM is low. So there's not a lot of money that goes into this space. Okay, there's a comment. I used to invest directly in stocks for short and long term. I would like to start SIP for active and passive funds for investment. Need your guidance. Can you share your contact details? Yes, definitely. This is our contact detail. Do get in touch. I've put out our email. I've put out our website. I've put out the number. So do get in touch with us definitely. Right. Uh, I've been investing in active, passive, and flexi-cap fund. How long should I invest? At what point should I diversify this portfolio? See, diversification is a completely different topic. Uh, See, right now you're doing active and passive, and within flexi caps, you're again in the passive, you're again doing your large cap. So you're not really diversifying. Honest truth, you're not really diversifying. You should have a good mix of uh, asset classes. Within equity, you don't need to have the same sort of category, within three, four funds or within active and passive. You should have diversity. You should look at diversification only when it comes to asset classes, and not within equity. I should have these many funds, and I will no. Then you're just foregoing your returns. You're not really diversifying, right? So your diversification only needs to come from asset classes, and that will give you an opportunity to look at commodities, to look at gold, silver, and debt funds. And wherever the opportunity is, depending on your risk profile and depending on your uh, goals that are coming in, that is where most of your money and that is where the allocation should be. Like, for example, if your ability to take risk is really high, but your willingness to take risk is really low, and you have short-term goals that are coming in terms of, uh, you know, repaying your loan or a house goal that is coming in, then you should have a good mix of, equity and debt. Something where it is safe and something where uh, you're able to take advantage of the Indian economy growing, right? So you should look at it that way. You should not look at it something that I need to make 20-25% return. No, what suits you, you should do. That's where our diversification really comes in point. In terms of active and passive, it depends on which passive you're doing. But my sense is that because most of the money is going into large caps, then you're doing the same thing. You're not doing anything different. So that is not diversification. So you do your diversification to asset classes. If you need help in terms of how you want to diversify your assets, the number is right there. Do call us or do reach out to us, and we'll be able to guide you based on whatever your requirement is. Uh, Whether we provide any other service for NRI other than PMS. See, I think we run a planning service. So you do reach out to us on this number, and we'll be able to guide you to the next steps. Review your portfolio again. You uh, get in touch with us on this number. Reach out to us on email, and we will be able to help you out. Does Milestone2Wealth include tactical entry exit to sectoral thematic funds? Yes, we do. We do now. Yes. It's not entry and exit. This is not a tip. We don't give any tips. This entire activity, this entire platform is meant for serious investors who are looking to build wealth. And that's why we have a lot of people working towards it. We are having a lot of research that goes into this. So it's not entry and exit over a short period of time. This is not something where we give you tips. If you're looking for tips, then you're on the wrong platform. This is us just helping you reach your goals, just helping you reach your milestones, where our entire endeavor is for you to save money and increase that and have that saving mentality where you're able to contribute a lot more towards your saving and use this as a financial vehicle, as a savings vehicle, right? This is a financial asset for you. It's an asset. So you need to see this as, a savings vehicle that is able to generate high long-term stable returns, right? This is what mutual funds do, and we are just trying to do slightly more than that, right? Which is enough for you to meet your goals, which is much more than FD, which is much more than inflation, which is again much more than your country growing, right? So if your country is going to grow, you're going to get a lot of opportunities, and this is where we would sort of come in. Yes, we look at everything. We just don't look at large caps. We look at all wherever there's an opportunity for investors to invest in. That's where we would be there. What is your opinion on sectoral funds? Sectoral funds and thematic funds are great. It's extremely brilliant. There's a lot of opportunity that comes in on sectoral and thematic. Why? Because cycles are different. Every cycle is different. Every cycle there's a different winner. Every cycle there's a different loser, right? And to take advantage of cycles, sectoral and thematic is the best way for any investor to look at. However, the skill that is required for any investor looking to do towards on sectoral and thematic is very high, right? Why? Because some cycles are more economic linked. That means if the economy does not grow, you're stuck there for 5 years. Wherever we have had that experience of uh, stretching out our investment horizon, it has always been positive. The output has been extremely positive. So, but in the current period, that the whole point of me showing the entire vantage point of Nifty also was that when Nifty goes through such problems, and Nifty is a good mix of all sectors, the overweight comes on the banking side, and it is extremely sensitive to economic conditions. So if that entire part of the market does not do well, then Nifty also does not do well, which means that your economy is not doing well. So there are opportunities that come to you within sectoral and thematic that are growth linked, economic growth linked, economic activity linked, and the time horizon needs to be stretched. But the risk that you're taking is quite high, but you're not taking undue risk. It's unless there's a good amount of research that goes into it. So we do have uh, uh, portfolios that run purely on sectoral and thematic funds. And we run PMS also in the same style. So Sphere is that PMS that is more thematic oriented, more sectoral oriented. So we do have that expertise. If you are looking for something on sectoral and thematic, then definitely do get in touch. Should I wait for gold prices to come down to invest in SGB? SGB is a great option for investors to invest in gold. You should not wait for I don't know why you're trying to trade this commodity, but gold as an asset class, every investor should have. This is where diversification really comes in. No, please don't wait for gold prices to come down. It's an 8-year horizon. So definitely, and you're being paid also by RBI or some form of interest that comes to you, and it's tax efficient. So definitely look at SGB. Don't try to time products. Right? Don't be obsessed with timing products. Do not be obsessed with timing products. Right? And every product is different, so you can't treat everything as equity. Right? What you've been doing on your uh, pure direct stocks, that you cannot do here, because that sort of behavior doesn't work there. What will work in assets that really don't require it. So don't try to time it. How much of gold is suggested in portfolios as part of M2W? It depends on your portfolio. If you're already on the platform, if you're already with us, then we will look at that and we can see, okay, as for you, based on your goals, based on your risk appetite, how much should be for you. It is not a one size fit all. It depends on you. It will be tailor made to you. Perfect. I think I got your answer. Yes, you are enrolled. Do get in touch with your point of contact, and uh, then we can take that conversation forward from there. There's one doubt. Somebody suggests 5 to 7 mutual funds may be good in a portfolio. See, it's not about the number of funds that you have. Again, it's not the number of funds that you have. It's what are the type of funds that you're investing in. I might have 5 funds or 7 funds that are large and mid cap oriented, and then 1 or 2 funds that are mid and small. So I'm not really diversifying. I'm still going to be within Nifty 250, right? And depends on the allocation that I'm setting to these portfolios also. I'm not going to go beyond, say, Nifty 200 or Nifty 225, something like that, where my weighted average market cap is only going to be skewed towards large caps. So it doesn't matter whether you're doing 5, 7, 10. My whole point is this is where within equity diversification comes in, where when you have that knowledge, we have just have somebody to guide you. Even that 5, 7 can work for you because every fund will be a complement to each other, right? That's why my immediate first thing was how much is passive as a percentage of your portfolio, and everybody replied saying it's not going to go more than 25. But yes, I have 25% of my portfolio within passives. And within passives, most of you said that, yeah, it is within large caps. So having a large cap passive fund and a large cap active fund, it's the same thing. It's not really your universe is extremely same, right? There are periods where it works. There are periods where it doesn't work. Now, this is a period where active share works. When you're at a low point, definitely there, when in a deep problem, right? Definitely there might come an opportunity for tactical. There's not that, but most investors are not here for tactical. They are here for extremely long periods of time. Right? It's nothing to do with I'm just going to put for 3 months and then come on. No, we are looking at a 10-year horizon. So 5 to 7 matters only when you're doing the same thing. 5 to 7 doesn't matter if you're doing different things. It's not so I might have 2 gold and everything else, or 1 gold, 1 silver, and everything else can be equity. So it doesn't matter 5 or 7 or 10 also for that matter. But if you're going to do 10 of the same thing, then it matters. If the 10 are different, then it does not matter. And not as in not different fund or a different fund house. I can't have 3 large cap funds from 3 different fund houses. It has to complement your portfolio. It should not work against you. Right. So that's where de-diversification is happening, not that diversification is happening. Right. Is it worth starting a SIP in your 30s, or should I have started early? No, it's the best time for you to start at your 30s, whether you're 21, 22, 23. We worked with investors who have started their SIP at 40 also. At any age, your SIP, definitely you should start. And 30s is a good, you have a good 25 years to retire after that. And I don't know how old you might be. You might be 35, so you have a good 20 years. Right. So you have a good 20-year period to save money and use this as a financial asset. And within those 20 years also, you will get periods, you will get at least 3 cycles that you can play. So definitely you should start your SIP. So you're not late. Please start your SIP. You're not late. I've put in our number also, so do get in touch with us and we will guide you on where you should be saving your money now in this cycle. Currently, BSA valuation is more than GDP of India. Does it mean that equity market is overvalued? Is it increased downside? Is there a downside risk? Carefully select stocks. See, again, my whole point is why should you get into all this? Why should you go towards one particular metric? There are many metrics that show that India is fairly valued. This is just one metric, right? And suppose your GDP again in the next 3 years go higher, the 6 trillion, 7 trillion mark that we are talking about, it reaches there, and then your BSE valuations look cheaper. Don't look and don't be fixated on one particular metric. Second, I think it's a headache for any retail investors to really look at direct investing. It's a really bad headache, right? It's a lot of stress. It's a lot of headache because here it's gambling. Then you're not really saving money. Your behavior is wrong when you're just trying to gamble money. You should be aware that yes, there are a lot of data that's out there, and I should be unbiased to all data that comes in. The newspaper is filled with data. Newspaper is filled with gossip. It's filled with masala. So I need to be unbiased towards these things. However, I will not miss that out. I will take note of it. I will consider it. But biasness should not come from whatever data is coming out. This data suddenly can change in the next 1 year, right? So you have to be conscious in terms of valuations. But investors don't really have the time in India here, unless you're full time doing this as a job to look at such data. If not, I think it's very evident. The previous participant said, "Is it too late for me to start my SIP?" I said, "No, it's definitely not." So SIP is the best way for investors in India to really save their money and grow at high rates. The only reason of why people are going towards direct investing is because that sort of high has come with investors, saying that on online platforms and other platforms where they are seeing other investors sort of show that yes, we have done this, you have not done this, and that FOMO factor comes in. That no, I had I done this, had I done that. No, forget about what has happened. You have something now, right? You should definitely take advantage of now, and you've set yourself a target. That's the whole endeavor of Milestones to Wealth, is to make you aware that there is a target that you can achieve. It's not for us. It is to make you aware that there is a target that you can achieve. And the only way where you can achieve it is for you to form habits, for you to do things in a particular manner, and you will definitely be able to reach that target. Virat Kohli would not have been Virat Kohli today had he not have going above Sachin Tendulkar as a target. Right. So that's what we are trying to tell you, that we'll make you aware that yes, this is a milestone that you can achieve. The question is, because to keep additional cash, you should always keep additional cash. There's no way where you have to keep low cash and be fully invested. Even fund managers keep cash. There is about 2-3% that goes in as holding cash. You have to always have cash because you don't know what's going to happen, right? You should take advantage of volatility that comes in. That's why you should have some percentage in cash, whether it is depends on your portfolio value, or depends on your, if there are goals that are coming in, then you need to have more. If there are no goals that are coming in, then yes, some amount needs to be there that you can take advantage of when there are volatile periods, right? There are periods where the volatility is so high that once you use that additional cash that you had kept, you regret it, saying, "Oh no, I could have kept it." No, 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 there's nothing of that sort. You should take advantage of like that. If that is the case, have more additional cash, or rather, uh, have some and use some during one stage, and then use the other part for the other stage. So you're not missing out. At the same time, you're adequately, in a good position. My next question is 5 to 15%. What is recommended at this stage? Anywhere between 5 and 7 is a good number for you to keep something in hand. This is very standard for you to take advantage of. If any volatile situation comes up, something comes up on the developed market where it affects emerging markets, you should have something that you can take advantage of. But if you're doing SIP, then I don't think that you should have something in your hand. I think that should also be invested, because SIP is the best way. Uh, but 5 to 7 is good. Okay, there's a question on, I've been investing in active funds since 2011. Went with a corporate investment company who advised me on funds to invest based on my goals in 2019. I was with 29 different funds. Then I started studying and moved majority to passive. It's more NASDAQ 100 and bonds with 10% in direct stocks. Okay, I think 29 funds is a little too much, but but it depends on what your advisor has said. Uh, it might be for you, it might not be against you. We don't know what it is, but if you're really looking for a review, do get in touch with us. We can review if you do still have those funds, and we can study it to tell you, okay, what's good, what's not good. But uh, you moving a majority of your funds to passive is a good decision, just for one reason why I think is because you are able to take advantage of global uh, uh, ETFs there. So you're having a good mix of global equity and direct equity. But in terms of direct equity, 10% is in direct stocks. So there is within those passive funds. Uh, I don't know whether it's more large cap oriented, or based on data that's there, it's more large cap oriented, uh, and that's fine. So all are small caps. So then that 10% in direct stocks is a good mix of large caps, mid caps, or what's the case? I don't know what the case would be. Okay, so then you're just doing the same thing. No, there's nothing different that you're doing. And what is there on small caps as passive funds? Let me just take that out. Yeah. So the AUM that is in small caps as index funds is also quite low. It's only 1,900 crores. Uh, and what has gone in this entire year is 431 crores. So yeah. So the AUM is quite low, and you're doing direct in small caps also. So and you're doing global. So what you're doing is an extremely risky sort of a scenario. Maybe it works for you. It depends on your risk profile whether it works for you or not. But having passive funds and having direct stocks, you are again your entire portfolio is you are only managing it actively, right? So I don't know what the cost structure would look like for you. I don't know how well it would work for you, but this sort of a scenario might not work for every other investor. It depends on their risk profile. It depends on their goal. Right? What might work for you might not work for everybody else. Right? But we would definitely like to look at uh, what you've been doing and see if there is something that we can add for you uh, based on your risk profile, based on whatever goal is there. So do get in touch with us. I am sure that we can come up with something that can work for you based on your risk profile and based on your goals. For 10,000 rupee SIP, uh, four funds you're investing, is it too much diversification? Again, it's not the funds, it's the kind of funds that you're looking to invest in. Nothing, it has nothing to do with 4 or 10. 29, I do think is a lot, but it's not, it has nothing to do with 4 or 5 or 6. It's the kind of funds that you're investing in. If money is going to the same place, then it has the tendency to work against you. It's not for you, but it depends on the kind of funds. Is it too much diversification? Again, diversification has to be more to do with asset class diversification and not within a particular asset class diversification, unless there's a particular opportunity. Like, okay, so you said large, multi, flexi, and focused. Right. So uh, this is fine. I don't think that there is anything that you're doing wrong. This is going fine. That you are going to be within that 200 250 segment. That is fine. Do we need to include global funds? See, right now the outlook for global funds is, so I had done an outlook couple of months back for global funds and global investing, and is it the right time to invest in global? So do you can look at it on YouTube on Milestones2Wealth. I'll just put out that. Yeah. So you can look at that, but the scenario has not changed much. What has actually changed from that outlook is that uh, growth that was assumed to be a lot worse is not worse. There are segments of within global that have not done really well, but there are segments that have done extremely well. There's a lot of polarization that has happened in terms of global investing. So what has happened is the top 10 within Nasdaq has done extremely well, which is technology, and the rest has not done well. Sorry, S&P 500, right? Just the top 7 to 10, they have done extremely well, but everybody else has not done well. And the commentary that is coming in from consumption-oriented companies is that their inflation is really hurting them, and that this interest rate hike that they have done very swiftly in the last 2 years, it has really gone out and hurt consumption. That is what we had assumed, that it will hurt consumption. It is continuing to hurt consumption. So we don't know what the Fed is going to do now in the next meeting. But the assumption is that rates would stay high for a long period. Even if there's a cut, it might not be a deep cut to what they say of bringing it back down, or rather bring their inflation down to 2%. But uh, interest rates are assumed to be high for an extremely long period of time. Now, what the Fed has been doing is they have a choice whether to forego future growth or whether to contain inflation. If they don't contain inflation, then uh, they are going to forego economic growth that's going to come in, and that a developed nation, a large developed nation like US cannot afford. Right. So they have said that no, we would take the short-term pain to contain inflation because the long-term impacts of not able to contain inflation is quite large. So that is what has happened. Uh, so within US, technology has done extremely well. And the commentary that has been coming in from technology is that uh, the hype around AI and generative AI has really played out well. There have been orders that have been coming in, but supply has not yet been coming in. Though this technological advancement would not, uh, this is something that is a decadal thing. It's not something that's just for a year or so. Innovations have to happen in this space for a decade. Uh, but the price that you're willing to pay for these innovations is quite high right now. Right. So calibrated approach on global funds need to be taken. Right. You can look at a long-term SIP, but nothing to do with anything on the short term. You can't see a COVID type jump from 20 to 21 and some bizarre investment behaviors happening again. But definitely it's a good opportunity because you will get businesses there that you will not get in India. So that is a good option. It's just that how you want to look at that particular space. I would look at that space as a long-term SIP. Nothing for me to look at performance in the next 4 years or so. I will look at something like that only after 4 or 5 years. If we invest in lump sum in mutual funds, how do we measure the risk if you go for active funds? How do you measure the risk if you go for passive funds? That I mean, I'm also still trying to figure out what is the risk that an investor takes, because risk for every investor is completely different. How the template for risk is that see, uh, there is no set, say this much should be in a particular segment, whether it should be large, mid, or small. No, no. Cycles work completely differently. What is the risk that you're taking in that particular cycle? Right. What risk am I talking about is business risk. Right. If there is a high business risk, then you can say, yes, there is a good measure for me to measure risk. The template that we have been given to measure risk is beta and standard deviation, that I think the mutual fund will publish on a monthly basis. You can see that data in their fact sheet itself. So beta and standard deviation is just a template to look at. It's nothing that uh, it's just data that and it's all past data. It's not forward data. What you should be looking for is forward data, and that measure of risk will only come for you when you're conscious of valuations and what you're paying for that particular business, or what you're paying for that in terms of valuations. It has nothing to do with uh, forward looking, has everything to do with valuation. But what it has done, the volatility that has come in, those measures, the past measures are more beta and more standard deviation oriented, and that gives you a good indicator saying, yeah, okay, if I go here, I can expect some volatility to come in. And then there are drawdown measures that come in to say, okay, how long does it take from a low point all the way to a high point? How long does it take for a fund to recover? All those sorts of measures come in, and that I don't think is available to retail investors, or specific data is only available to retail investors, that we have to calculate, and that your advisor would be able to help you out on that. What should be the allocation percentage between active and passive? See, again, this has nothing to do with how much you should be on the passive side, how much you should be on the active side. First thing is, if you're having your SIP, very good, that's your one check. Second, what is the goal that I'm really investing for? Right. Some goals you can only do with active, some goals you can only do with passive. some sort of a retirement wealth creation goal, you can have a mix of active and passive, where your passive should complement your active. Right? If your active is more large cap oriented, then your passives need to be complementing it. It should not be in the same segment. It should be complementing where the fund is. And this I've been telling in every uh, uh, webinar when I get this question. Your passive should complement your active. If your active is doing one particular job, your passive should complement that job. A husband and wife will work as a complement. If the husband is going to do the same thing what the wife is doing, and the wife is doing what you're, then that entire part of the house is getting missed out of. Right. So it has to be a complement. Right. So passives need to complement active. So where the active misses out on, not in terms of returns, but in terms of overall allocation, there your passive should come in and take front. Right there. So we have been doing this active and passive on sphere where we have, a good mix of passives that complement our active. Right. It's like a basket approach. Right. So a basket approach would work only when it is a complement, nothing where it's just doing the same thing. It's going to work against you. Uh, thank you, sir. But we would not be able to share the PPT. It would come out on YouTube, so you can look at the entire thing on YouTube. But thank you for joining in. I think this was the longest session I have done till now. Lot of good questions. A lot of good questions. Okay, there's a question on small caps providing extraordinary returns in the recent months. At this stage, investors should be cautious and risk in falling into the trap. I hope that's a scenario where for active funds unfolds. Active funds are already unfolding. You are seeing in the last 1 year is already unfolding. And in the last webinar, I had shown, it's nothing against small or mid caps. But you should be aware of the data. See, within small and mid caps also, there are segments that are extremely cheap and that cannot come to you when you take a broad-based approach. There you have to be very concise. So within there, you have to be concise, and that's not a risk that retail investors should take right now, right? Uh, that's a risk that we're trying to do, you know, on PMSs, on where we can't take a broad-based approach is there where we would take somewhere of a uh, concise approach for small and mid caps. Nothing against. There are great businesses that are there that are very hard to replicate, right? But we are in this space of broad-based investing where money has only been going into for this entire year has been going into small and mid caps. You can look at that presentation that I had done. It's there on YouTube, where about you know 35,000 crores have just gone in this year into small and mid caps, where you're seeing active outperformance starting to come off, where you can clearly see that there's a sign where investors are chasing returns. So our endeavor is what we would be able to do for you on Milestones2Wealth is make sure that you are there in the right segments of the market during cycles, right? So you would see underperformance coming in, and anybody who's investing on the passive side also would see underperformance coming in for 3 years or so. So we are taking that risk of being early. Right? That's the risk that we're taking. We're taking the risk of being early and eventually catch up. So now that catch up is sort of happening. So I'm telling you now that no, there are a good amount of active funds that have been outperforming, and that number is only going to go up as we keep getting in more money. If the money has been going into the same place, then you're already seeing that sort of come off. So where you have to be in which parts of the market, that we will be able to help you out. So I put in the number again. Get in touch definitely. But what the numbers show is definitely that investors need to be cautious of falling into that trap. That there is a risk. There is a definite risk. So do not fall into that trap. But it's nothing against small and mid caps. There are great opportunities for investors to look at uh, small and mid caps. There are great opportunities, right? So most of your sectors and thematic also are small cap oriented only. Uh, you know, Niches are small cap oriented except for banking IT. They're all large cap. Everything else happens to be your small and mid cap. So we have been able to tactically manage the risk in small and mid caps, by putting our expertise on, sectoral thematic investing, where you need to be in which segments of the market. That's where we are coming in. That's where we are able to help you out. Right. So Definitely thank you all for joining in. I don't know if there are further questions. So I'll just keep the floor open for 1 more minute or so. And whatever questions you have, please do type it in. There's a comment saying individual investors getting trapped there and M2W really helps us. Thank you so much that we've been able to help you out. Do share us a review if you can. And definitely bring in more people into these webinars because these data take me a long time to do. The entire team works really hard to put in facts and to put in the truth outside. Right? It has nothing to do with putting somebody else down, but it has everything to do with making the investor aware of what is happening so that we can help you be on the right side of things. And when the time comes to be on that side of the market, be rest assured that you would be there. There's a question on can I start a SIP in small cap now? Depends on your time horizon. Valuations right now are quite frothy in small caps. That's why I said that a broad-based approach would not be beneficial because the valuations are slightly expensive. And compared to large caps do have a deep discount. So small and mid caps compared to larger players are trading at a high premium. Uh, so it depends on your time horizon and depends on your risk appetite. If your risk appetite is high and your time horizon is extremely long, that is anybody looking to do 15 years, right? That's where your investment should be. When you retire 25 years from now, then why should you have, 5 years as a horizon? So it depends on your condition, depends on your scenario, and depends on your risk appetite. Right. So you've told me the horizon, then it depends on your risk appetite. You cannot say that yes, I'm an aggressive investor based on whatever calls you have taken couple of years. No, it depends on your ability and your willingness to take risk. It depends on your financial conditions and depends on what goals that you're coming in, whether you can afford to take that risk or not. That's what you need to see. Uh, Thank you so much. Again, this is a platform where I would use this as an opportunity to address whatever questions you have. So please don't degrade yourself by telling petty questions. These are all very, very good questions that you had. And I use these platforms only to interact with all investors, interact with everybody on that comes in. So hope I have done my best to answer to all your questions. So thank you so much all for joining in. Have a great weekend ahead. All of our content would be online. You should follow us and get on. Reach out to us uh, on the number that I had provided, and we'll definitely be able to help you out. Thank you so much. Thank you, guys.